All right, good afternoon, everyone. My name is John Harrington. I'm an advisor at Milestone Financial Planning. Today's webinar is going to be discussing the One Big Beautiful Bill and the tax and financial planning impacts of it. Today, we're joined by Jen Climo, another advisor at Milestone Financial Planning. She is a CPA and CFP, very well versed in tax implications, and she's going to be answering a lot of questions today about the One Big Beautiful Bill. Before we get started, nothing you hear today should be considered tax, financial, or investment advice. It's information only. And if you want to use this information to make a decision related to your personal circumstances, please contact a qualified financial professional. All financial decisions will impact your income taxes or estate taxes now or in the future, and you should individually look at how these consequences could impact you personally, like I said, with a qualified financial advisor. We have a lot of ground to cover today, over about 40 slides. Please feel free to ask questions. You can do that in the Q&A section of Zoom, or you can do it in the chat, and we will do our best to answer the questions while we're going through the presentation or at the end of the presentation. If you'd like to download the slides, feel free to use that QR code that is on this slide here. And if you have any direct questions for us, you can reach out to us at info@milestonefinancialplanning.com. So first slide here, what is the One Big Beautiful Bill, OBBB? It's essentially making the provisions that were in the Tax Cuts and Jobs Act in 2017 permanent. And there's also a slew of other things that were added to the bill that President Trump proposed while he was campaigning. And there's a lot in here. You look at what was passed, and it's a lot of incremental changes to the tax code. You might see one or two things that affects you personally, but there's a wide range of provisions that are complex, complicated, and you really have to look at them in total when you're looking at, like, how does it affect me? And we're going to get into each provision of the code that with respect to tax and financial planning topics, and kind of dig into those and give you an idea of how they might affect you personally. All right, the first thing that we're going to look at is federal marginal income tax rates. And the OBB made these permanent. Jen, what is the impact for individuals
Thank you,
with this
John.
provision?
Well, we now have certainty over the tax rates. As you all know, especially if you're clients, we had a lot of uncertainty over the past few years whether or not we were going to get a giant tax increase on January 1st, 2026. Thankfully, that is not the case. So as these tax rates have now been made permanent and no expiration date. So that's great.
All right. Awesome. Is the same true for capital gains and qualified dividends? I know there's some decoupling between the 0 and 15% capital gains tax rates and the marginal tax rates.
That is exactly correct, Sean. And that gives us a weird situation where in 2025, you could have a situation where you incur capital gains taxes at 15% when you're only in the 12% tax bracket. So that's not great. That's sort of a weird thing, but only to the tune of $250 in income in 2025. But 2026, that difference is going to be much larger, on about $2,000 of income. And I expect that to widen over the years. I'm guessing this is something they're going to patch eventually. Who knows when? But for right now, it's something, another reason, one of many, why tax planning individualized to your circumstances is so important.
Okay. The standard deduction changed under the Tax Cut and Jobs Act. They increased the size of the standard deduction and got rid of personal exemption 7 years ago. How does OBB change this? And is there anything important to note with regards to the standard deduction?
Well, John, the standard deduction is now permanent, as we all know, at these much larger amounts. So 15,750 is larger than the 15,000 that was slated to be per person in 2025. But there's no huge changes in the standard deduction other than the dollar amount, which is here. Now there are lots of additional deductions on top of the standard deduction, which we will talk about shortly.
Okay, and in this next slide here, my understanding is they added a bigger deduction for people that are age 65 plus. Is that for everyone that's 65 plus? How does this work?
So this is pretty much everyone who's 65 plus, except if your income is over these thresholds. This starts phasing out at, depending on your income level, could be a low rate. So if you're single, it starts phasing out at 75,000 of income and is fully phased out at 175,000, meaning if your income is over 175,000 and you file single, you will not get the benefit of this extra $6,000 per person. Now, if you're married filing joint, those phase outs are larger. 150,000 it starts and it's gone by 250,000. But if you're under those amounts, you will get some portion of a $6,000 per person deduction for being over 65 on top of your standard deduction or itemized deductions for that matter.
And the phase out happens if you're married filing jointly. The phase out is happening simultaneously if you're subject to it.
The phase out is between 150 and 250.
Okay, and this is a lot of these things we'll be talking about today have expiration dates on them. This, as the slide says here, is only good through 2028. Is that true?
That is correct. And in addition to that, these are stacked deductions. So the standard deduction, if you qualify or itemized, is taken first, then this $6,000 per person. Then you also still get the old over 65 extra standard deduction if you take the standard deduction, which I think is $1,600 per person if you're married filing joint. And then there's a blind one as well. So these just stack on top of each other.
Okay, and this slide here shows how they stack up on top of what you were just saying.
Correct.
So if you're married filing jointly, you could potentially have a $46,700 standard deduction in 2025.
Exactly. And this is why many people are no longer going to be itemizing their deductions. You have to have a lot of deductions to get over this threshold.
I would agree. And we're going to talk about some of the new itemized deductions that were either adjusted as part of OBB or were introduced as part of OBB in some future slides here. All right, anything else to talk about with the standard deduction before we move on to Social Security income?
Not on this one.
All right, so if you're getting Social Security or nearing Social Security, you may have gotten an email from the Social Security Administration shortly after the OBB was passed into law on July 4th. That email alluded to the fact that Social Security income was going to be exempt from taxation. That is not actually part of OBB. What they were saying was that because of this new and temporary 65 plus standard deduction add-on, that 90% of the population that is getting Social Security would no longer be getting taxed on that Social Security income. So Social Security income is not explicitly being excluded from income as part of the OBB, but it is effectively for 90% of the taxpayers in the United States because of this new standard deduction add-on. That your take on it too, Jen?
Yes, with one important note, which is this deduction is allowed whether or not you itemize.
The 65 plus deduction?
The 6,000, yeah.
Okay, perfect. All right, now we're going to move on to itemized deductions. There's quite a few things in here. We're going to start with SALT. SALT is the state and local income tax. That's your property tax. That's tax you pay to, the state for any income that you earn Not every state has income tax. For instance, we're in New Hampshire. We don't have an income tax here, but all the states around us do, including Vermont, Massachusetts, and Maine. Salt was one of the topics that was in the press quite a bit leading up to the OBB passage because it had been previously capped at $10,000 and it was increased as part of this. Jen talked to us about how the salt deduction is working under OBBB.
What's super interesting about this one is it's $40,000 salt cap, state and local income tax deduction cap, whether or not you're single or married filing joint. It's very interesting. So also it starts to phase out between $500,000 and $600,000 of income, meaning that if you're over $600,000 of income, the deduction is back down to $10,000. But if you're between 5 and 6, it's somewhere in between 10 and 40, and below 500,000 of income, it's $40,000. So that is a huge deal, and that doesn't matter if you're single or married filing joint. It's the same $500,000. So that's interesting. This slide also does mention the PTET rules, which is applicable to small businesses, and we will talk about that on a next slide when we get to the small business changes.
Okay, so everyone's eligible for 40,000, but if your income's over a certain limit, it could get whittled back down to the 10,000 that we had in 2024.
Correct. And one item to note, if anyone remembers the AMT, it's a different tax way of calculating your taxes that used to add additional taxes to people's tax bills. This is a preference item. So we might start seeing more AMT show up if people have a lot of what's called preference items, including this deduction. We'll have to see.
Okay. And this, interestingly, is from 25 to 29, whereas the additional standard deduction was only to 2028. So you see, as we're going through these, I talked about complexity before. All of these different provisions have different, they're either permanent or they have different ranges of, year applicability, or they're subject to phase downs or reductions based on income. It's a lot to consider for, each individual. You have to kind of look at this stuff individually. All right, the next thing we're going to talk about is mortgage interest. What's important here? It doesn't look like much has changed, but maybe on the margins.
It didn't really change the mortgage rules, which changed a few years ago to say the cap is only on mortgages with up to $750,000. That's the same. It's just been made permanent. However, there is a big change in that additionally to mortgage insurance, they made PMI, premiums deductible on acquisition and indebtedness. When you buy your house, if you put down less than 20%, then you might have to have a higher payment for mortgage premiums. Those amounts are going to be deductible now. And I believe it's unlimited. So that's could be a big help to people buying houses.
Okay. So when we're looking at, like, in terms of, am I taking the standard deduction, whether I'm 65 plus or not, this is one of those things that's going to now be able to be permanently part of your equation. You have what you're paying on interest on your mortgage, and then if you have PMI, that's now being able to be added to that as another deduction to try to get over that standard deduction threshold.
Correct.
All right, charitable contributions. I know there are some big changes with regards to charitable contributions. This is one of them. What's the deal with the floor on the deduction of charitable contributions?
So this could potentially be a big deal, but for a lot of people, it will be a little deal. First of all, many fewer people are going to itemize their deductions. This only applies if you itemize your deductions, and it just means that 0.5% of your adjusted gross income comes off the total you contributed before you get to deduct anything. So that's not a huge dollar amount for a lot of people. However, a lot of people only give a few thousand to charity anyway, so it could be a large percentage of their donations are out the window, not deductible. What's really interesting about this is that if you give very large amounts so that you exceed the AGI thresholds on this slide. So 60%, you can deduct up to 60% of your income in charity, generally 30% if it's capital gain property. If you exceed those limits, the 0.5% does not apply. The AGI limit the charity that's carried forward to the next year, and the 0.5% is carried with it. So that's just a little interesting notation. But other than that, everyone's going to have this 0.5% limitation. Even if you made $1 million, 0.5% is only $5,000. So $5,000 would come off the top, and then you deduct the rest.
And the 5 that you can't deduct gets carried forward to the next year for
only gets carried forward if you donate so much that you exceed these limits of 30, 50, 60% of your income. If you don't exceed those amounts, that the 0.5% is just gone.
Oh, okay. So in your
Forever.
previous example of the $1 million AGI, you would have to be giving over 600,000 in cash, let's say.
Yes, if you were giving cash, that is correct.
Well, that's a pretty big donation.
Yes, it is.
Okay, moving on to casualty loss. This is something we really don't see a lot in preparing tax returns. Does this matter, Jen?
The reason we don't see this a lot is because it's after insurance proceeds are received. So usually, a lot of times when there's a giant loss, there are insurance proceeds received, and the net loss is not a large number. If it is a very large number, then you get to deduct it. And the only thing different than previous law is they added some state declared disasters to the list of disasters that qualify, not just federally declared. The rest is not different.
Okay. Do you see this a lot when you're preparing tax returns?
Never.
Okay. Wagering loss deduction. This is something that was also in the press quite a bit. Las Vegas doesn't seem to be too happy with this part of OBB. I've heard that they're going to change this, or get rid of it maybe, and an amendment to the bill. What's the implication here? Why is Vegas not too thrilled with this part of the bill?
So this is super interesting. Most people on the tax returns I prepare, they just have the random winning or losses. This isn't going to be that big a deal. If you pay $1,000 on a bet and you win $2,000, you can only deduct 90% of the 1,000 you paid, or $900 against your winnings. Where this gets to be a really big deal is professional gambling. If you were a professional gambler and you made, let's say you had $1 million of winnings, but 800,000 of losses, you've netted 200,000 of taxable income for the year. Well, if you can only deduct 90% of your losses, now you can only deduct 720,000 of losses against your $1 million in income, and you have an extra $80,000 in taxable income, even though you only ended up with 200,000 in cash. So this is very bad for people that make their money on this sort of thing. And just as John alluded to, I was reading that there is some talk about a new tax bill in the fall, bipartisan agreement to fix a few things in the bill. This is one of 2 big things in this bill that is likely to be adjusted in the fall. But who knows what will happen? I don't know.
So basically it's like saying, like, if you're a gambler, you automatically have to include 10% of your winnings because you can only deduct 90. Is that?
It's actually way bigger deal than that, because you're taxed on all of your income and you can only write off 90% of your expenses. So it effectively increases your tax rate. This is a tax rate increase on people that are gambling. They don't like gambling income. That's what this says.
All right. Well, just don't be a gambler. All right. Moving on to miscellaneous itemized deductions. This was something that you could do prior to the Tax Cut and Jobs Act for stuff like investment expenses. As an example, TCJA temporarily suspended miscellaneous itemized deductions. Are they coming back in OBBB? And what is this new educator miscellaneous itemized deduction?
Basically, all of the old miscellaneous itemized deductions are out the window, gone forever. They're not coming back. However, there's a new one. So educators, if you were a teacher, you may recall that you can deduct up to $300 of unreimbursed expenses if you go out to the store and you buy crayons for your classroom because the school doesn't give you enough supplies, or you buy tissues or whatever, and you bring all that back. Up to $300 a year, you could deduct. $600 if you're married and your spouse is also a teacher and spends the money. Now, in addition to that, it does appear this is in addition to that, there is a miscellaneous itemized deduction, unlimited in dollar amount of any amount that you spend to furnish your classroom of unreimbursed educator expenses. The question is, with the standard deduction being so high, are teachers really going to be able to itemize their deduction to take advantage of this? I don't foresee a lot of this actually going into effect simply because most people can't itemize anymore.
And does it have to exceed the 2% of AGI threshold?
Nope,
It does not. Okay.
it's just miscellaneous, not 2%. 2% is gone.
Okay. We have one more for itemized deductions. There's a new limitation on itemized deductions. If your income exceeds a certain threshold, it gets reduced. Jen, what exactly, how does this affect people that have either high itemized deductions or high income?
This only means this only affects you if you're in the 37% tax bracket, and your income has to be pretty high to be in that tax bracket. The slide has the limits. If you're in the 37% tax bracket, you're only going to benefit from your itemized deductions up to the 35% tax bracket. So that's really all it means. You're going to get back 35 cents on the dollar, not 37 cents on the dollar for your itemized deductions.
Moving on to QBI, this was another provision that came in as part of the Tax Cut and Jobs Act. The House had a lot of change. The House version of the One Big Beautiful Bill had a lot of adjustments to QBI. A lot of those were taken out in the Senate version and the final version. What was left in it, Jen? What matters here in terms of QBI and OBB?
Well, the great news is this deduction was made permanent. This is fantastic news for small business owners, particularly micro business owners, those whose profits are less than 500,000, say, from their business. Then you still get to deduct 20% of your business income, effectively reducing your tax rate. That's the whole idea of this, to what the corporate tax rate is already. The other issue here is the phase out of this deduction is fairly low, and they capped it for service industry businesses, which includes not only accountants and financial advisors and lawyers and doctors, but it also includes entertainers and artists do not get the benefit of this if they are over the income thresholds. It's completely phased out for small businesses with taxable income, not adjusted gross income. Important difference. Taxable income of $272,000 if you're single and $544,000 if you're married filing joint. It is totally gone, and it phases out slowly below those amounts. The bigger issue here is that they made no changes to something called PTET, which is a workaround for businesses to be able to deduct the state and local taxes. Now, you might not need that anymore if your income is less than $500,000 because you can write off now up to $40,000 on your taxes. But a lot of small business owners with larger businesses, their income is over the $500,000. So they would be capped back at $10,000 for their state tax deduction once their income's over 600,000. So for those businesses, it does still make sense to a lot of different states pass these really arcane rules, and it's different in every single state. But for example, in Massachusetts, they let the business pay the individual state income taxes on behalf of the shareholders, and the shareholders get a 90% credit, a credit for 90% of what they paid in on their personal taxes. Therefore, it's a workaround way to be able to deduct the tax expense because the businesses deduct it. And that Congress was going to make changes to this, and they did not. So that is still allowed, and it's a way to get around the SALT limitations.
That's good news. You talked about the AGI limitations and phase outs for certain industries. Does that apply to just the business income or REIT dividends or both?
I believe REIT dividends are not considered that special SSTBs. So REIT dividends, everybody gets 20% off their REIT dividends. That's not different. That's the same. That's different just for your business income. If your total income is over the 272,544, then you're going to phase out of any sort of deduction for QBI.
For people in those industries. Okay.
Yeah,
And
for people in those industries.
the new minimum there is just a way for people that have very micro businesses to
Yes.
get a good deduction, even if it's the 20% is lower than that.
Yes, they used to only used to have 2,000 of income. Now they cut that in half. So that's actually really good for, like I said, this is great for micro businesses.
Awesome. All right, now we're going down to below the line deductions. These appear on the 1040 after adjusted gross income. So while they still reduce taxable income, they're not as beneficial for when you're looking at like phase outs that are based on AGI because they don't reduce AGI. Be interesting. There's quite a few here. Be interesting to see how they handle fitting them all in on the 1040. It's already pretty packed in 2 pages as it is. I don't know where they're going to put these on the actual form, maybe another schedule or reduce the font size, but time will tell. The first one up here is charitable contributions. Jen, you alluded to this earlier when we were talking about the charitable contribution reduction for certain incomes and for people that itemize. Now there's a new one for people that aren't itemizing. Saw this in COVID, I think, for a couple of years. What is this all about?
So this means if you can't itemize, which probably most people cannot, then if you give to charity, you can write off $1,000 per person. So $1,000 for you. If you're married filing joint, you can write off $2,000. It is not subject to the 0.5% AGI floor. And I don't believe there is any AGI limitation here. And this is not effective until next year.
2026, okay.
That is correct. Also, another point is you can't contribute to your donor advised fund this way. This is only for a cash donation, and a cash donation in IRS terms means check or credit card. You can't actually write off cash.
Okay. And this doesn't, so that obviously doesn't include my runs to Goodwill.
Correct.
Donating furniture and books and
Correct.
kids clothing.
That only applies to people who itemize.
But is that $500 minimum threshold still around?
Yes, and all that means is if you give away stuff worth less than 500, you can just throw 500 on your Schedule A. But if you give more than 500, you have to gather a lot more information and fill out Form 8283 and delineate it there. But you certainly can deduct more than 500 a year. It's just a lot more burdensome in terms of paperwork.
Gotcha.
But no changes were made to that.
And you have to itemize.
And you have to itemize. That's right.
As we've already gone over here, many people aren't going to itemize because of the standard deduction increases. Okay. No tax on tips. This was another thing that got a lot of press. I've heard that it's not as great as people think it is. What's the rules around reducing the tip income?
Well, I think it's pretty great for low income folks and especially college students. College students up to $25,000 of tip income is exempt. It's not exempt. So you report the tip income on your taxes, and then later on the tax return, you take a deduction for said tip income up to $25,000. So there's a lot of, they have to release a list of industries where this applies, but if your grandchild or child works in a restaurant and does not make over the thresholds of 150,000 single, 300,000 married filing joint, they're going to be able to take this deduction. It again is below the line, so it does not reduce your adjusted gross income. but I do think it's going to help a lot of people that get the majority of their income from tips. You can take, it's 25,000 per person. So in theory, you could deduct up to $50,000 on a tax return for this if you both have a lot of taxable income. However, you were not eligible for this deduction if your business, if you're self-employed and your business is the aforementioned SSTB, a service business. So what they're basically saying is, no lawyer, accountant, doctor, you can't get tips. But what that they actually threw in here is no musician, artist, entertainer, you can't get tips either. Those people are not allowed to take this deduction. It's pretty much geared at the restaurant industry, I think, and ballet and other traditional tipped industries.
Uber drivers.
Yes, Uber driver is a good example.
And you actually have to report the income in order to deduct it. So if you get tips and decide not to put that as income on your tax return, then you can't say, oh, well, I also didn't get any tip income, but I'm going to deduct it anyway.
That's correct. And there's two other items to note, which is this is not no taxes on tips because you still have to pay FICA taxes on your tips. Social Security, Medicare, that is still something that has to be paid. Also, yesterday, the IRS said there will be no changes to Form W-2 this year, meaning your pay stub will have to be given to your tax preparer for both this deduction and the next deduction we're going to talk about, which is overtime, because otherwise they're not going to know what your tip income is.
Because it won't be on the W-2.
It will not be on the W-2. Tax preparers were surprised, I think, to see this, but I think it's because they couldn't change the W-2 in time.
Yeah, that makes sense. And this is another one that's only applicable for 4 tax years.
Correct.
25 through 28. Yep. Okay. All right, you alluded to the next topic, no tax on overtime. Talk us through this one. I recently read that some industries are going to be exempt from this, sort of like you were talking about for the no tax on tips. What's the deal with this one?
That is correct, but of course the rules are completely different. This one is only for the income earned above your base rate of pay. So if your base rate of pay is $10 an hour and you get double time, so you're at $30 an hour, that difference of 20 is in addition will come out as an additional deduction, similar to the tip deduction. If your time and a half, it's just the incremental above your base pay that will be used to calculate the deduction below the line, does not reduce adjusted gross income. This phases out again at the same limits as the tip deduction, 150,000 single, 300,000 married filing joint, and completely different from the tip deduction. It is 12,500 if you're single and 25,000 married filing joint, as opposed to the tip deduction, which is 25,000 no matter what. And the other thing, as John pointed out, is that you only can take this deduction if your overtime is mandated by the FLSA, which is the Fair Labor Standard Act. That means if you're getting overtime as part of a union contract, you cannot take that deduction. And also, overtime pay required by state law also does not count. So there's going to be a little bit of research in the beginning to determine whether or not that overtime pay counts for this deduction.
Okay, so a bit of a marriage penalty on this one as opposed to the no tax on tips. All right, moving on to the next one. New car auto loan interest, another below the line deduction. Seems to be a good benefit for people that are buying new cars. What do you think?
I do. Some of you may remember way back when personal interest was deductible in the 1980s, car loan interest was deductible way back then. When I started in the industry, it had just phased out completely. So luckily, I didn't have to deal with that. However, now it's back. Car loan interest on new cars produced in America only. Now, how can you tell if the car was produced in the United States? It's an excellent question. We put a little link on the slide. So if you download the slides, you should be able to hook up with this link. But it basically, if you look at the VIN number of the car, and I learned something I did not know, which is the first number in the VIN number tells you where the car was made. So if it's a 1, 4, 5, or 7, that's made in the United States. Now, is that an IRS approved way of determining? I have no idea. There's just a lot of information out there on how do you know if the car is made, because sometimes parts are coming from here and there and it's assembled. And what does that even mean? Made in America. So this seems like for today a good way to figure that out. Um, also, this is phased out again at pretty low income levels. So $100,000 if you're single, 200,000 married filing joint. So it phases out for a lot of people, but it is another below the line deduction. Also, it only applies to vehicles with a gross weight of under 14,000 pounds. So I'm not sure a really large SUV or truck would qualify here.
How would you figure that out? You have to weigh it on a scale or?
Believe it or
Uh,
not, we had to do this when we were doing trying to depreciate business vehicles. And when I did business taxes back in the day, you have to actually have the client look at their paperwork when they bought the car, or that little sticker on the car door. It tells you what the gross weight is. Or you can look it up now. You can just look it up online, I guess, and see what the gross weight of the vehicle is. But it's a pain.
okay. And the limit of 10,000, is that interest on 10,000 or
That's
$10,000
10,000
worth of it?
interest,
Okay.
10,000 worth of interest expense up to, which would be a pretty expensive car loan. So I'm not sure. Yeah, we'll have to see
Yeah, if
how
you
this works.
7%, I mean, that would be pretty big loan. And again, that's only for, there's another time limited deduction only for the next 4 years.
Right. And it does phase out over 100, 200. So it's completely phased out by 149,000 if you're single and 249,000 if you're married filing joint. And it,
Okay.
yeah.
Another layer of complexity, all three of these, the tips, the auto loan interest, the overtime, all have different phase out rules. So it's one more thing to have to calculate. All right, here's a summary of above and below the line deductions. Some of them are existing under the Tax Cut and Jobs Act, and the new ones that came into existence under OBBB are all highlighted at the bottom, and we talked about all of those. But there's a lot, and I was talking about fitting all this stuff on the 1040. Typically, all these have one line, but they may put them on a schedule so that it's not as the font's not as small.
I think they'll show up on schedule 2 or they'll add another schedule. It's hard to know. The
Yeah.
important thing here is that the IRS has also just recently come out and said that tax season, they will not be ready to accept new tax returns until February 17th. No electronically filed tax returns until then. That's about a solid 2, 3 weeks longer than usual. They used to accept them in the late January. So it doesn't affect us typically because we can't file till later due to tax forms not being out on time, but that is a big deal for the general public.
All right, so people who are getting refunds because of all these new additions to the tax law will have to wait a little bit longer if they were
Yep.
used to filing as soon as they could. All right, that's good information to know. All right, next up is tax credits. Tax credits are dollar for dollar reductions in what you owe, sometimes refundable, often not refundable. First one we're going to talk about is the child tax credit. This is extremely important for people that have children. It's something I've taken advantage of in the past. What are the new rules with regards to the child tax credit, Jim?
They're actually pretty similar to the old rules that were under the Tax Cut and Jobs Act. It's just been made permanent and they increased the amounts a couple $100. So that's great news, especially for low income people. There is a phase out, as you can see on the slides, but not a lot of changes here. It's just making it permanent.
And a couple extra $100. Okay, well, it's something, right?
Yeah, absolutely. Every bit counts.
All right, dependent care credit. This is for people that are paying for expenses for childcare. How is this changed under the bill?
Well, that answer depends on your income. If your income is under 75,000 single or 150,000 married filing joint, this is great news because there is a larger amount of income allowed before the credit phases down at each level. If your income is above those levels, then you're getting to deduct 20% of your expenses, capped at $3,000 per person per child, $6,000 if you have more than one child. So but it's a big deal for within those brackets, those lower brackets, more money is going to be allowed to be taken as a tax credit.
Oh, that's great. Yeah, that's a significant change, as you noted, for people that I mean, childcare is so expensive these days. This is going to be a big improvement. All right, the next one is the premium tax credit. This is one of the most confusing aspects of the tax code, and it's changed quite a bit between Tax Cut Jobs Act. During COVID, we had the ARPA in 2021, and then the Inflation Reduction Act changed it again. What is the current bill doing to change the premium tax credit subsidy?
What this is basically doing is taking this law back to when it was originally passed, meaning that there is no more income cap that is gone. This is another one of the things that I've been reading about that Congress is thinking about changing and going back to the law that allowed not have an income cap, which means if your income, no matter what your income was, if you paid more than 8.5% of your income in healthcare premiums, then you could take a tax credit for that difference. Now, obviously, the higher your income, less likely that was to happen, but it sort of allowed everybody to limit their health insurance premiums based on their income, which was helpful. That cap is now gone for 2026, and the health insurance premiums have always been reconciled to your income on your tax return at the end of the year. But the changes in the tax law over the past couple of years meant if it looked like you had taken too much of a advance tax subsidy, you didn't have to pay it back if your income was under 400% of the poverty level. That is now gone, so that you do have to pay it back if you underreported your income when you got the tax subsidy. So that could be a big cliff, that could be a big number. And I think that people will be surprised when they start looking for health insurance in November to take effect January 1st, because this isn't effective until 2026, but people will start being affected by it in November, December, as they find out what their premiums are going to be for 2026, especially if their income is above 400% of the poverty level and they were getting a subsidy, they're in for a giant surprise. That's not going to be good news. And that's why I think Congress is talking about changing this.
Okay, but yeah, that's a good point that it's not going to affect the tax return for 2025.
That's
so
true.
People won't have to be surprised with owing money because of this change. But yeah, that's a big difference for 2026 and forward, especially for people on the healthcare exchange plans.
Yeah, if this is not changed, then the people over 400% of the poverty line are going to get, so many people will be surprised on their 2026 tax returns.
In terms of the
Having
credit
to
available
repay.
to them, or
Yes, the credit available to them, and and having to repay any difference when they're used to not having to do so. So hopefully all the people working on the exchange will work with people this fall to educate them about this.
Okay. Oof. Could be
Yeah,
a tough
good
one.
job.
Next, the credit for other dependents. A lot of people don't know that this even exists. When personal exemptions went away in the Tax Cut and Jobs Act and the standard deduction went up, they put in this $500 credit for other dependents to sort of give a credit to help offset the costs of your dependents. And it's made permanent in the OBBB, so we can continue to use that for tax returns, which helps people that have other dependents. But it's pretty straightforward. All right, this was another one that people in the Northeast certainly are going to hate, I think, because all the clean energy credits are pretty much going away with different timelines and how people can take advantage of them with the limited time that's left. Jen, what's the deal here?
So there was a $7,500 tax credit for buying a brand new electric car, but that expires next month. And not all cars qualified, so it was complicated in itself, but it is gone if the car is not purchased by September 30th of 2025. Then there is also the solar tax credit, which a ton of people, I do this all the time on the tax returns, have taken advantage of installing solar on their primary residence and taking the tax credit of up to 30% of the solar costs, which is unlimited, honestly, up to whatever amount it costs you to put solar on your roof. And if you can't take that credit all in 1 year because you don't pay that much in tax, then the credit carries forward to the next year. And that is not changed by these changes. The only thing that is changed is that if the system is put in service after December 31st, 2025, you can't take a tax credit for solar. That's what's changed. So it's when is the system in service. This does not affect the ability to take the tax credit on your 2025 return and then have some carry forward to a future tax year.
So this is not refundable. In other words, this tax credit is not refundable.
Okay. No, it's not refundable. It offsets tax liability. That is correct.
And there are AGI limitations on a couple of these. I know the clean vehicle credit has one.
The clean vehicle does.
But any of the other ones?
Not the solar. It's the clean vehicle one is 150,000, 300,000 if you're married filing joint.
All right. Disappointing, especially for people that were planning to put solar on their rooftops. Try to get it in before the deadline is over. All right, now we're going to get into other provisions of the One Big Beautiful Bill. There's quite a few here. We're going to try to get into as much detail as possible, but we only have 10 minutes left, so we might have to get through these slides quickly. Again, if you have any questions about your personal circumstances, please feel free to reach out to us. First up, AMT. Jen, quick summary of what's happening here.
A quick summary of one of the most complicated sections of the tax code, which is the alternative minimum tax, which is a side-by-side way of calculating your tax bill compared to the regular way, and then whichever is higher is what you pay. We haven't seen AMT since the Tax Cut and Jobs Act basically eliminated a lot of the preference items that made it calculate, but now it may come back because of some of the changes that were made in the tax bill. Again, this is so complex, I would not venture to speculate if this will affect you without doing a tax projection. Some quick projections I was doing this morning, I still don't think it'll affect a lot of people, but it certainly could in the future. They did make some changes here, which are outlined on the slide. The only thing I will note here, the biggest impact will be if you have incentive stock options, or if you know somebody that does, that is definitely a preference item if you exercise them and hold the stock. So you will definitely want to ask a tax professional to help you out and figure out whether you should exercise those in 2025 or in 2026 once some of these limits take effect.
Okay, good to know. State tax and gift exemption amounts, they were already at 14 million in 2025 because of how the 10 million from the Tax Cut and Jobs Act were increased because of inflation adjustments. OBBB just makes this permanent and sets it at 15 million going forward from 2025, also indexed for inflation. So this is good news for folks that have very large taxable estates. It gives them more confidence in terms of planning, because there was always sunsets to these amounts in the past. And now, I mean, it could be changed by a future Congress, but as far as this particular number, it's set in stone for now. There's no sunset of it in the future.
That is correct, John. We have certainty now.
Yes, we do. All right. Eligible expenses for 529 plans. I think this is a good one, Jen. What are the details here?
So 529 plan changes. They changed the rules for what is a qualified expense, and those rules take effect now. So you can start taking out of your 529 if you had to have some of these qualified expenses this year. With, however, important to note that the K through 12 expense limit was $10,000 and still is $10,000 a year in 2025. That does not increase to $20,000 until 2026. But the definitions of what you can take out and spend the money on is in effect right now.
Perfect. It's a great savings tool, and broadening what people can spend the money on, I think, is a good thing. HSAs, there was a lot of changes in the House bill, House version of OBB. A lot of that got stripped out in the Senate version. What's changing here for health savings accounts?
Not a super ton, but a few basic things, which is if you have a bronze plan or a catastrophic plan, you no longer need to wonder if it qualifies for an HSA. Those will all automatically qualify for HSA. Also, there are some relationships where you can have a direct primary care agreement with your doctor where you pay a couple $100 a month and you get services that can now come out of your HSA. And telehealth is now covered and eligible to come out of your HSA if necessary.
All right, that's great. I mean, HSAs are an extremely powerful savings tool, and having the increased flexibility of what types of plans are eligible for HSA contributions is fantastic.
Yep.
All right, the next one, Trump accounts. This is another thing that's been in the press. Before we kind of get into whether or not they're any good, just give us a quick summary of what these Trump accounts are.
This is a new type of tax deferred account, in addition to all the ones we already have. Very low contribution limits of $5,000 per year for anyone under age 18, and the U.S. government will kick in $1,000 in the first year for kids that are born between 2025 and 2029. So that's interesting. There are very complicated rules surrounding these accounts, so we're not really sure if they're going to take off. And it's interesting because I've seen some people describe them as flexible distribution rules. We didn't think the rules were all that flexible because until you're 18, the money is stuck. You can't really take it out in between 18 and 59 and a half. It's subject to the IRA distribution rules. So that doesn't seem very flexible to me. And it's a pretty low contribution limit, and your employer can put money into one of these up to $2,500 for one of your kids in an account that's going to be locked for a long time. I'm not really sure that makes a lot of sense, but that's what they are.
Okay. You mentioned the distribution inflexibility. We have the rules here on this slide. Also, there's some limitations on what type of investments can be used inside of the plan. The Treasury Department has some time to figure out how these are going to look and how they're going to be set up. As Jen mentioned, right now I don't see any real positives here. I think there are better options for people to save for their children's education and retirement. And we've listed those on the next slide. So Jen, you want to kind of run through some of these?
Yeah, sure. So a Roth IRA is obviously a great option, but you can't contribute to a Roth IRA for your child until your child has earned income. So they can't really get a job until, I guess, 10, they could have a lemonade stand or something. So, but that can delay contributions, where the Trump accounts, you can start it as soon as they're born. In this case, you can't contribute to a Roth till later. 529 plan for college. This is a great idea, especially I love this for grandchildren. You can open up a 529, and if there's money after college or they don't go to college, up to 35,000 of that 529 can be used for future Roth IRA contributions for the beneficiary under certain situations. Another option is the UTMA accounts, where you can just open an account with you as custodian for your minor child, but that money will transfer directly to that child when they turn 21. And if the income is significant in that account, it gets taxed to the parent at the parent's tax rate. So it's not a terrific option, but it is an option. And or one of my favorite options is just wait, make some 529 contributions when they're old enough, and then wait and contribute, give them the money to make their Roth contributions when they're young adults and working and their income is not that high. The gift tax limits are currently $19,000 per year per person, so that seems a lot higher than these $5,000 here or there. So I think those are all probably better options right now, unless you have a baby born 25 to 28, in which case, why not set one up to take advantage of the free $1,000?
Unless you have to do it on the U.S. Treasury website, which is extremely confusing for anyone to use. So we'll see what happens there. If they make this into like a Roth IRA instead of a traditional IRA, it may be a lot better. But as it stands right now, Jen, I agree with you. There's much better options. All right, able accounts. Able accounts are sort of like 529 plans for people with disabilities. They came around in the Tax Cuts and Jobs Act. Great tool for folks that want to maintain eligibility for state benefits and still have a little bit of money set aside for living expenses. They're now permanently able to be used and accept rollovers from 529 plans. They also are now eligible for the Savers Credit permanently, and they will be the only thing eligible for the Savers Credit starting in 2027. After that, their like retirement plan contributions will be eligible for something called the Savers Match, which will be a direct deposit of up to $2,000 per taxpayer directly into a 401k or IRA. I have no clue how that is going to be implemented. That seems like a enormous task for the Treasury Department to be able to pull off with the number of custodians we have for 401k plans. And I don't even know how you do that, but they have a few years to figure that one out. All right, student loans, Jen. OBBB seems to really change the landscape for graduate students in terms of how much they can borrow.
Yep.
What's the deal here?
This rule means that the federal school loan limits are going to be lower going forward, which can be seen as a positive because students were borrowing far too much and not understanding that they had to pay it back and getting into huge amounts of debt. So that was a bad thing. However, this could affect affordability of school. The thought is that if there's less federal money available, maybe prices will come down. But what's really probably going to happen is that other lenders will come in to fill the gap. Private lenders and whatnot will loan for this. There's another new provision which may help students, which we're going to discuss shortly on another slide, almost our last slide.
Okay. Yeah, this is big. Last slide here. We have two more slides. This one is a summary of some of the other provisions. We can just run through them. Jen, you want to take?
Yep, I'm just going to talk about what I think is going to affect the most amount of people that are here on this call, which is the dependent care FSA increasing to $7,500 per year next year. That's a big deal to help people with who work for an employer with an FSA dependent care plan to pay for their child care. And also the limit to send a 1099 to your vendors that have earned more than used to be $600 in a year is going to be $2,000, but that's not effective till 2026. So you still have to send 1099s if you pay someone over $600 this year. And if you're on the receiving end, you should be reporting that income no matter how much you get, but the 1099s next year, you're not going to get one unless you were paid over $2,000 by that vendor. Another item is Form 1099-K, which you get if you sell a lot through Venmo, PayPal, or some of these online agencies. They now have to send 1099-Ks if you have $20,000 of transactions a year. So that should reduce the amount of 1099-Ks. There was an old limit, but it never got implemented. So I guess this has been the limit that they've been effectively using, but this is great news. That's great news for small businesses. And regarding direct file, because they did also wipe out direct file with the US government for people to file their taxes if they had very simple tax returns. That is now also gone. And the theory is the TurboTax and some of these other vendors already have a free file program. So it seemed duplicative. And people in Congress were worried about the IRS being responsible for tax prep, tax collection, and tax enforcement. I don't know. That, and as well as data security.
Okay. Let's move on to scholarship granting organizations. This is an interesting one, something I'd never heard about before the bill. What is exactly is this?
This is something I had never heard of before either. Apparently, there are some charities that give out scholarships, and that's their primary purpose. And now the IRS has called out a very specific type of charity that it's going to give a benefit to individuals on their tax returns to take a tax credit of up to $1,700 for donations if you make a donation to a charity that primarily gives out scholarships. How are you going to know that's the right kind of charity for sure? How are you going to know to claim this deduct credit on your tax return because it is capped once 4 billion of these have been gone out? Done. I have no idea how they're going to implement this one.
Okay, well, I guess we'll see. Probably best for people that were already doing it and eligible to take advantage of this credit, dollar for dollar. All right,
For sure.
that's it. That's our last slide. We're going to move into questions. If you want, there was a question, can we get this slide deck from your website? Yes, you can by clicking on that, using a camera for that QR code. We're also recording this webinar and we'll be posting it on our website under videos within the next week or so. Jen, we did have a few other questions. Let me see if you covered these. For Roth IRA contribution eligibility, does earned income that is excluded under the tip deduction, does that count as earned income for Roth contributions?
I believe it still does because the IRS code defines compensation as earned income, as gross income, and the new rule did not change that. It gave a new deduction in the form of tip income. So I do not believe that this affects your ability to contribute to a Roth.
Great. So for people that are earning a lot in tips, they can make that full. You mentioned college students.
Yep.
They can make that full $6,000 contribution. Okay. And then there was another question about solar system placed in service in 2025. Can the credit be carried over? I think you answered that.
Yep.
Going forward. One other one, is the child tax credit refundable?
I think the answer to that is yes, that rule did not change. Up to a certain amount of that, $1,700 is refundable. That was not different. But it will increase with the child tax credit going forward for inflation.
Okay, so there's no changes to the refundability of the child tax credit, just still the same rules there. Okay.
Yep.
One other question was, are you going to mention crypto and private equity and 401ks? This was something that was passed yesterday by the president, not part of the one big beautiful bill. And no, we're not going to mention that as part of the presentation today. If that's something that you're interested in and your custodian allows that, that's something you should work with a advisor on for your own personal circumstances. Any questions that I missed, Evan, Kristen?
No, I think you got everything.
All right.
Great.
Thank you everyone for joining today. As I mentioned, you can reach out to us directly. We got our email addresses here. If you have any questions, you can also use that info@milestonefinancialplanning.com email address. The slides accessible via that QR code, and the full recorded webinar will be posted on our website within a week. Appreciate everyone getting on today and hope you have a great weekend. And thank you, Jen, for all your insight today. It was great.
Thank you, John.